The Trade is brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.
Hello and welcome to The Trade. Let's get into what traders are watching out there, with Japan's top economic negotiator saying that tariff negotiations with the US cover how Japan can expand trade, non-tariff measures and economic security cooperation. Japan's finance minister also saying Japan's huge $1 trillion plus in US Treasury holdings among the tools available for Tokyo to use. Apple trimming its share buyback program by $10 billion. Amazon reporting first quarter cloud revenue growth and forecasting operating income below estimates. Let's get across the technicals with Ilya Spivak from tastylive, who joins me now. Always great to see you. Ilya, what are we seeing in terms of, I guess, the seesaw in some of these stock markets after Liberation Day?
Very good to be with you, Juliet. And indeed, the first chart that I have here for you is the S&P 500, which I think really illustrates very well where we've been and where we've arrived. Obviously, we see that massive seesaw for the month of April, where we break through that 55 or so level, 55, 55.10 on the S&P, race down into the low 48 hundreds and then recoil back. And that's really that Liberation Day gap and story. And of course, the idea there is that we're not just entering a trade war. The U.S. might, on the reading of this panic, be looking to dismantle the entire system of global trade that it itself built up after World War II. And of course, the question then becomes, are we really going to cut off the channel by which the proceeds from sales into the U.S. are recycled as dollars back into U.S. markets? What does that mean for treasuries? What does that mean for the faith and credit behind the U.S. dollar? And really very existential questions for the entire system. And of course, the markets panic. And we really don't get the start of a rebound until those reciprocal tariffs are somewhat watered down, at least temporarily. Of course, they still go up from an average tariff of 2%, fivefold, to an average baseline of 10. But at the very least, everything beyond that is put on hold for negotiations. And even perhaps more importantly, the administration signals that it is not beyond market discipline, that there is a pain point eventually.
Yeah,
and
sorry, Ilya.
Yeah, and so
I just wanted to move on to the bond
right.
chart as well, because there's so much concern here about what is happening in the US economy under the hood, particularly
right.
when you look at that GDP print. What are we seeing in terms of the panic from the bond market's point of view?
Well, that's right. So this is that same kind of seesaw. And what you see here is, of course, at the beginning of April, it's a sell America kind of a thing. It's very telling that before you have that, it's more a sort of regular recession dynamic. So from mid February, let's say, until about mid-March, it's just that the chaos around the implementation of the tariffs is creating this sense that this is hurting growth. It's showing up in business and consumer confidence. This is going to be recessionary, stocks down, dollar down. This will be rate cuts, bonds up. And then at the beginning of April, the tone changes significantly, and you have that aggressive bond sell-off around the surging term premium in treasuries, because the uncertainty is so high, and there is this almost like a sovereign crisis in lighter form for the U.S. And what we find is that as the administration finds the pain point and steps back right around 111 there on the 30-year, you get this almost unclenching of that concern. And of course, that matches with the rebound in the stock market, where it seems like we've stepped back from the brink of a kind of system-wide rupture and back into a sort of regular recession territory.
All right, the Aussie dollar, I mean, for those of us travelling, looking very good compared to a couple of months ago. What are you seeing there with the momentum?
One really interesting thing in this entire episode is that we've, of course, seen stock markets unclench. They've erased their sort of April panic. Bond markets have mostly erased it, not quite as much as stocks. The dollar has not found the same kind of support. So we see the Aussie here surging from just over the 59 mark all the way up to about 64.50. And it's holding there in a narrow 100 pip range between about 63.50 and to 64.50. So the dollar is not seeing the same kind of relief. And that's probably because as we get back into this sort of normal recession dynamic, we get the sense that the Fed is going to cut rates. And the GDP report is actually an excellent example. The negative 0.3% number is maybe overdone, and everybody's talked about, oh, this is just surging imports and surging inventories because people are front-running the tariffs. Missing in all of that hand-wringing is that consumption, which is 68.5% of GDP. That put in the weakest growth in almost 2 years. So we have the raw data and the hard data to tell us that a very significant U.S. slowdown is coming. And that probably means that we're going to have more aggressive Fed rate cuts. It's probably bad news for the dollar. So this consolidation may lend itself to another leg higher for the Aussie.
Yeah, indeed. All right, Ilya, always a pleasure. Have a great weekend. Thanks so much, Ilya Spivak from tastylive. That does it for this edition of The Trade. Be sure to join us next time.
The Trade was brought to you by Vantage Markets, delivering one of Australia's most trusted and award-winning trading experiences. Explore smart trading at vantagemarkets.com.au.